Hey, welcome back guys. My name is Makita, bringing you another video today. Taxes. We all know what they are and those of us with income pay them. Well, at least I hope so. Otherwise you're committing tax fraud and you should probably call Saul. Taxes come in many different forms and are applied when there's a monetary exchange. Simply put, this means whenever money changes hands. Originally, income taxes in America go back to the Civil War when Abraham Lincoln signed into law our first ever tax on personal income. Though the Civil War led to a creation of the first US income tax in the US, the federal income tax as we know it now was officially enacted in 1913 after being appealed prior to that. The 16th Amendment to the United States Constitution was passed in 1909. It allowed for individual taxes regardless of state, population, or location within that jurisdiction, and this required all Americans to pay federal income tax since 1913 when it went into effect. Individual income taxes, federal, state, and local, are the largest source of tax revenue in America. They make up 41%, while social insurance takes up 24%. Next comes consumption with 17% and property with 12%. Of course, by law, any American whose gross income is over $10,000 or $25,000 for married couples filing jointly, or who earned more than $400 from self-employment, must file a federal income tax return. There are also payroll taxes, capital gains taxes, and property taxes. Property taxes actually differ from the others because this is a percentage based on the assessed value of a held asset. Essentially, you're paying the government to continue owning your home, whether it is paid off or not. We will also get into more about this later regarding delinquent property taxes and how some people use this as a way to make money. The government uses taxpayer dollar for things like social security, defense, education, and infrastructure. Now let's look at each one of these in a little bit more detail. Federal taxes are imposed by the US government and are based on your income. The amount you pay is determined by how much you earn annually. The federal tax system is progressive, which means that the higher your income, the higher your tax rate will be. Sales taxes are imposed by state and local governments on the purchase of goods and services. The amount of tax you pay depends on which state you live in, as well as the type of product or service being purchased. Some states do not have a sales tax, while others have a very high sales tax rate. Income taxes are imposed by federal, state, and local governments on your earnings from employment, interest, dividends, capital gains, and other sources. The amount of tax you pay depends on your income level and filing status. In California, the state income tax rate as of January 2022 is 13.3%. Shown in the data, we can see the different tax brackets for the different amounts earned. Payroll taxes are imposed by the federal government on wages and salaries. Capital gains tax is a tax on the profit from the sale of an asset such as a stock, bond, or a piece of real estate. The tax rate depends on your income level and how long you held the asset. Here's the tax bracket regarding the capital gains tax rate. Property taxes are imposed by state and local governments as well on the value of real and personal property. The amount of tax you pay depends on the value of your property, the tax rate in your area, and any exemptions or deductions that you may qualify for. When it comes to real estate sales, the government offers a special deal if you sell your principal residence. The first $250,000 of an individual's capital gains on the sale is excluded from taxable income, or $500,000 for those married filing jointly as long as they have owned and lived in their home for at least 2 out of the 5 years leading up to it being sold. This makes them tax-free. If, however, someone buys less than what was paid, then there will be no deduction because these losses come from personal property such as homes. Selling a capital asset after owning it for less than a year results in a short-term capital gain, which is taxed as ordinary income. Long-term capital gains result from selling capital assets owned for more than 1 year and are subject to a tax rate of 0%, 15%, or 20%. There is a flat 28% capital gains tax on gains related to art, antiques, jewelry, precious metals, stamp collections, coins, and other collectibles, regardless of your income. States like Alaska, Florida, Nevada, and a few others have no income taxes. Therefore, they don't have any capital gains tax either. If you're lucky and you reside in California as we do, then you get a piece of the pie from each form of tax paying. However, the grass isn't always greener because in Texas, which doesn't have any income tax, ranks number 37 for highest property taxes. California ranks at just number 14. Now that we have a basic understanding of the different types of taxes, let's look at how they are calculated. First off, federal taxes are calculated using a tax table which can be found in the IRS instruction booklet. The tax table shows the tax you owe based on your income and filing status. Sales taxes are calculated by adding the sales tax rate to the price of the product or service being purchased. Income taxes are calculated by multiplying your taxable income by the tax rate. Payroll taxes are calculated by subtracting the amount of withheld taxes from your gross pay. Property taxes are calculated by adding the tax rate to the assessed value of your property. Capital gains tax is calculated by subtracting the cost of the asset from the sales price. Now let's look at some of the common deductions and credits that can lower your tax bill. Deductions are expenses that can be subtracted from your taxable income to lower your tax bill. Common deductions include mortgage, interest, charitable donations, and state and local taxes. Credits are subtracted from the amount of tax you owe. Common credits include the child tax credit, the earned income tax credit, and the renewable energy tax credit. There is, however, one way you can go around this. What you can do is partner up with your high school chemistry teacher and manufacture methamphetamine that can be sold for cash, and you won't have to pay any taxes on that earned income. However, it's not actually that simple, and if you actually want to spend the money that you make, you would have to clean the money through a process called money laundering. Now, this is when you take the dirty money that was earned through the illegal activity and convert it into a legitimate source. Buy a cash-heavy business, for example, a car wash or casino, and mix the dirty money with the earned income from the business or clean money, inflating your profits and allowing you to come out with clean, usable, and taxable income. On the other hand, if you were to go out and spend lots of cash and live a lavish lifestyle on a small income, the IRS can audit you and investigate the source of your cash. The IRS requires that banks report any cash deposits exceeding $10,000, and they must do so within 15 days of receipt, and it's not as cut and dry as simply having to report one large lump sum payment, making multiple smaller transactions count for much more than just the total amount deposited. For example, if you're depositing $2,000 each day over the course of a week, then your bank would become suspicious when those amounts combined exceed $10,000 in value. Another scenario would be depositing cash across several banks. Let's say you deposit $6,000 into one account and then make two separate cash transactions of $3,000 each at different banks. This could potentially trigger the bank to file a suspicious activity report or SAR with the federal government. If you don't pay your federal taxes, the IRS can take action to collect the money you owe. This includes seizing your property, filing a notice of lien, levying your bank account, garnishing your wages, or even jail time. All states, including California, have a process that allows the taxing authority to sell a home to collect delinquent taxes. Now here's where we get to the part on how someone can use your delinquent property taxes to obtain ownership of your home or charge you interest. If an investor decides to purchase a tax lien, the investor must pay off the outstanding property tax bill plus any fees or penalties. Then they will reclaim the debt from the current homeowner with interest. If the homeowner fails to repay their debt, the investor is given the legal right to obtain the property's title in the form of a tax sale. In short, guys, make sure you pay your taxes, otherwise you can end up in some legal trouble. Other than that, I hope you enjoyed this video. Please don't forget to leave a like and subscribe for more content, and until next time.
Disclaimer: Moskalenko Brothers does not condone the purchase, sale, use, and production of methamphetamine, also included, but not limited to money laundering and tax fraud.